What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is September 15th of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I want to have a brutally honest one-on-one conversation with you guys about the current state of Bitcoin, crypto, and the broader asset markets as a whole. This is going to be a video where I'm going to be diving into some really important data points that I think no one is covering, but outside of that as well, I'm not here to just do a routine technical analysis on crypto. I believe today we need to talk about how over the next couple of years, we need to completely rethink our approach to investing, whether that's active or passive. And we need to understand that the previous investment assets that yielded the best returns may not continue to be the same assets that lead out over the next couple of years. There's always opportunity out there in the market. It's about where you look in order to find that opportunity. We got a lot to unpack here in today's video. It's going to be a jam-packed episode. You guys won't want to miss it. So if you happen to enjoy it, consider dropping a like. It's one of the greatest ways that you can support the channel. And let's go ahead and kick off the rambling. All right. I want to go ahead here and again, not so much focus in here on Bitcoin. Over the last couple of days, we did get a nice little bump up here. But again, we've had these little rallies and sell-offs. And generally speaking, we're pretty much neutral ever since the pullback back here in mid-August. And we've been generally facing, again, long-term resistance against the previous range of support in the last bull market. And I know everyone's got different opinions here. Some believe we're in a bull and bear market, but perhaps in today's video, we can step away from the Bitcoin price chart. We can step away from the debates about a Bitcoin ETF and all those different types of topics and get back to the fundamentals, right? Cut out all the headlines, cut out all the noise, cut out our desires for what we want to happen, and just focus on some really interesting data points. Let's take a look here at the first chart. This is a chart that I feel I really have not seen many people covering. It has to do with Forex markets or foreign exchange markets. And essentially we're focusing in on the currency rate or ratio between the value of one currency to another. All right. So today we're going to be actually taking a look at one specific currency pair, and then we'll dive into the broader dollar index and its performance. This is one of the most telling charts of our time. This is the USD JPY ratio, essentially the US dollar against the Japanese yen. Two very high level leading world reserve currencies in many ways. These are areas, again, where people feel safe investing their capital, essentially being able to maintain some kind of purchasing power versus a lot of other currencies in the world, right? If you put both of these currencies next to one another, they look much better than most other currencies in the world, right? But I want to go ahead and spend some time here to talk about why we're starting to focus in on this chart. We've been talking about this since back in 2022. We've been really covering this chart for a long period of time, but really honing in on this since back during the dollar's initial strength in 2022. Now, I want to go ahead here and talk about why this chart is incredibly important. You might ask, Nick, what does this have to do with Bitcoin? And again, I come back to it, as I always say, it has everything to do with Bitcoin here. Take a look at this chart here. Since back in 2012, the dollar has continued to garner strength here against the Japanese yen. So essentially, just so people just understand this fundamentally, for those who may not trade in Forex markets or might have a difficulty understanding what this kind of score ratio is, or this value in the chart, this number here, 147, is how many Japanese yen you get per dollar, right? So if you think about it that way, we're essentially getting nearly 150 Japanese yen per dollar here at current market rates. Back in 2011, we would get around 77 yen here. So, basically around half of what we would get today, right? So essentially we get twice the amount of Japanese yen per dollar we have today versus what we got back in 2012. And that also had declined significantly from back in 1971. Essentially, we used to get 357 Japanese yen against the dollar. But as the Japanese economy grew and accelerated towards actually becoming one of the largest economies in the world, pretty much in the position China is in today, as Japan's economy was accelerating into the 70s and 80s, that ratio got stronger and stronger, all right? And essentially speaking, since then, we've been re-accelerating back on the side of the dollar. And we are testing up towards a range that has not been revisited or passed since back in 1990. Now, anyone who will trade in Forex markets will tell you that this is a significant chart. We have blown past the 200-week and the 200-day, and once more, we dipped below the 200-day and actually deviated back above there. To dive into a shorter-term time frame, we can see that we dipped below the 200-day and re-accelerated back higher, right back to where we were back in October 2022. Now, the reason this is so important is because we are about to set the highest level for the dollar against the Japanese yen in well over 33 years. And this speaks towards a very important reality we need to discuss. When we take the monetary policy of the Japanese economy versus the United States, Japan is still at practically 0% interest rates. Japan is still doing quantitative easing to some degree, or is not engaging in proper quantitative tightening. And we know that the United States is in a completely opposite scenario. It is contracting its balance sheet, it is raising interest rates and keeping them suspended well above many other central banks in the world. And because the dollar is essentially the world reserve currency and the Fed needs to defend that status, well, we can generally see here that when you have those counter opposites, you're going to see the dollar continue to garner strength. Why? Because the dollar is more scarce. The yen is easily accessible. Interest rates are low. Loans are still cheap. You can easily get Japanese yen out there in the economy. It's very easy to do so. So essentially speaking, we have two counter stories here. We have the Bank of Japan and the Federal Reserve, which are enacting completely different monetary policy. And this has been, again, a divergence that's been building up. Japan has not been showing up to the plate for the last decade, whereas the Fed is continuing to tighten. And this is not a good sign here for, kind of generally risk-on mentality, right? We should essentially be seeing, if the Fed is going to be pivoting sometime soon, we should be seeing the dollar is going to get weaker, right? If FX markets are starting to price in and they're highly efficient, similar to the bond market in many ways, we should start to see that essentially there's a repricing. We should see the dollar starting to lose strength if the Fed is going to pivot, and if we're going back to la-la land where the Fed's just going to print money anytime something goes wrong, and we can bet that valuations of assets are just going to go up. But we're not seeing that. And we're not seeing that as well, not just in the USD JPY ratio, but we're also seeing it here within the dollar index. Since back here on July 15th, back about 2 months ago, we have continued to re-accelerate in the dollar to its highest level since back in March of 2023. Now, this is the dollar index, or the DXY, which measures the dollar's performance against a broader range of currencies, mainly in its performance against the euro, the Great British pound, and the Japanese yen. That's going to be the major weight here. Now, generally speaking, a lot of people were expecting over these past couple months, many people were short the dollar because of all the news around BRICS, which is the new alliance between many nations, not only to ideally build new economic trade relations, but also eventually ideally work towards building some new currency for trade and interaction between one another that circumvents the dollar. And that has been the narrative for everyone out there. The death of the petrodollar, the death of the dollar essentially being the world reserve currency. And while this is a narrative that gets touted a lot, and while I understand the anger and frustration many people have with the US that may lead them to want to see something like this happen, at the end of the day, the rate doesn't lie here, guys. The DXY is not lying. There is more demand for the dollar, and it's growing right now. And you can tout any headline you want, but it's the reality here. Now, why is that? Well, outside of all those, hopeful arrangements and hopefully maybe having some kind of impact against the dollar, at the end of the day, dollars are used everywhere in the world. It is the world reserve currency. And because it is the world reserve currency, if it is continuing to tighten its monetary policy, not loosen, meaning that the balance sheet or the available supply of M2 or the overall currency supply is decreasing, and if we are seeing higher interest rates, meaning that it's more expensive at banks to take out credit card debt, auto loans, mortgages that essentially lead to the creation of new excess money in the system, right, making it more difficult for that to happen, then essentially you are going to see the dollar continue to go up, and you're going to have a downward pressure on assets and other currencies in the world and their purchasing power. That's the fundamental reality of how it works. Now, if the Fed starts to, say, oh, we feel we've dealt with inflation, and on top of that, we need to print money, which is very unlikely, then yeah, the dollar is going to start losing strength. But we can see here that the dollar made a monstrous move since here in 2021 against other currencies, and it looks very well like it has turned. If we zoom out here again towards those longer term time frames, it has turned a previous range of resistance into a year-long range of support. Right, I want to go ahead again, turn off the drawings here just so you can see this here. This is what happens when we zoom out on the long-term time frames. We can see that this general range between 100 and 103, which was resistance here in April of 2020, here in December 2016, here in November 2015, and March 2015. This kind of decade period where we had a lot of resistance has been turned into new support. It's a catalyst for the dollar to continue moving higher, and it's a visual marker for how the Federal Reserve is continuing to tighten, and it likely still has a ways to go and continue tightening. And we can see, we need not look further here than, again, just zooming out to the longer term time frames, going back to that quarterly chart. Each of these candles represents a quarter, so we're looking back all the way since the 1960s. We can see that, generally speaking, the dollar comes up here towards this 120 point range here at 123, or what we saw in the 80s, again, as the Federal Reserve essentially tampered inflation, right? We started to see the dollar rally to its highest level against other currencies at 160 points. These are generational cycles here that come and ebb and flow due to various reasons, some of which we know and some of which we don't. Some of which are easy to predict, some of which aren't. At the end of the day, we are in an accelerating trend for the dollar. We've had lots of these little pullbacks, nothing substantial that doesn't keep us from setting higher lows and higher highs and whipsawing back higher. So as we're going into an environment where dollars are increasingly scarce, they have increasingly higher purchasing power in the world. That sets the tone here. When we have interest rates, as we can see through treasury yields, the 2-year treasury yield, like many others, whether you look at the 3-month yield, whether you look at the 2-year yield, whether you look at the 10-year yield, the 20-year, 30-year yield, all these treasury notes are still trending higher, setting higher lows and higher highs. They are indicative signs that the Fed is going to continue tightening. And if you need to look any further, right, we can take a look at, for example, crypto-based liquidity, right? Crypto stablecoin liquidity, right? If we just put it here the regular charts, but easier to see, we've had a 20% contraction in liquidity here in stablecoins in the crypto space. And simultaneously, that has played a big role in continuing to reduce the valuation of crypto assets. This is a great visualizer here, and I think it's going to prove pretty valuable here as we go throughout this conversation about how liquidity is so important here, right? So if we are going to be in an environment where liquidity is contracting, how is that going to impact crypto, right? Well, let's just take a look here at the growing importance of liquidity. We can see here that, for example, from April 2019 towards July 2019, when we had a initial relief rally before we really kicked off the bull market later on, we essentially saw Bitcoin accelerate from $3,500 all the way up here towards around 13K at that time. And that was during a period of time where we saw about 119% increase in stablecoin liquidity, a doubling of stablecoin supply in the crypto space. And it makes sense. You had a surge of liquidity in the industry, and that allowed for an increase in the overall valuation and essentially the overall valuation of cryptocurrencies as a whole, whether that be Bitcoin or altcoins. And in a period of time where that stablecoin growth kind of stagnated, well, what happened here? Well, the trend stagnated. And sure, we had the pandemic. I'm not here to say that that's why it dropped 75% from those relative peaks. What I'm here to say, though, is that there's a very clear reason, and it wasn't just the pandemic, as to why Bitcoin stalled here. Because there wasn't liquidity expansion, right? Now, what happened when we did get some liquidity expansion? What happened when we started to see in a single week the stablecoin supply increase by 28%, and a couple weeks later 34%, and a couple weeks later 37%, and week by week by week by week by week, month by month by month, we started to see increases of liquidity. Well, what happened? We got a mega bull market here. We came from those lows at around, the actual lows here, it's not reading on the chart properly, it was around like 3,900 all the way up here towards $69,000 or $65,000 in May of 2021. Now, what did it take though for us to do that, right? It was a huge move, right? And don't let people tell you, oh, but in previous bull markets they did more and stuff. Yeah, it's diminishing returns, right? Bitcoin's growing as an asset. We get that. But like, what did it take fundamentally for that to happen? It took an over 2,183% increase in stablecoin liquidity to do that. Liquidity and price acceleration go hand in hand. If you have declining liquidity or stagnant liquidity, price is likely not going to expand. This is true not only for global assets like US equities or foreign equities like stocks, but also as well for cryptocurrencies. ever since that trend started to slow down, where that acceleration, right? If we take it here, we got it on the logarithmic scale. When the acceleration of that stablecoin liquidity slowed down, right? You can see the direction of price when that liquidity is surging. And when month by month, you're seeing increases of 35, 30%, 12%, 12.8%, 8%, 21%. Serious single digit or double digit increases in liquidity, followed by a continued acceleration in Bitcoin's price. But when that started to slow, Bitcoin started to stagnate. And when we started to contract in liquidity, Bitcoin started to correct in price. So what we're seeing here with each and every bull market as Bitcoin gets bigger and bigger, its appetite for liquidity is growing. And that makes total sense, right? For these assets to continue doubling, for Bitcoin to go from a $500 billion asset to $1 trillion, and to go from $1 trillion asset to $2 trillion, and to go to $2 trillion to $4 trillion, you're talking about mountains of valuation increase, which is going to require a bigger amount of dollars in order to do so. Well, we are in a contracting environment still. Whether people like to think about it that way or not, dollars are becoming more scarce. Stablecoin liquidity does not lie here, guys. Week by week, month by month here, generally speaking, we are still seeing a decrease in stablecoin liquidity, and it's following our global liquidity index that we track here in the channel, which you guys saw probably in our last upload, right? It's not me bashing on crypto. It's about the status of liquidity in the space. Now, there's one last thing I want to talk about here to kind of build into this topic of Bitcoin and the previous market leaders. Many people have just gone back to buying Bitcoin, Ethereum. They're buying into the FANG stocks, which are Meta or previously Facebook, Amazon, Netflix, Google, also as well Apple and Microsoft, as they've been kind of the big tech giants out there that have been cash rich. And many people believe that these stocks are just going to be the best bet to go into for the next couple of years because they're just going to keep getting bigger and bigger. From a fundamentals perspective, again, I could talk to you about how I don't believe Apple is going to be able to continue innovating and building new products. And the same goes for all the FANG stocks and Microsoft. They've really saturated themselves already. And you can see specifically with the FANG stocks, this same kind of typical behavior of dinosaur companies that have reached their peak growth. Netflix cracking down on too many people using their accounts. Google as well, following in the footsteps behind Microsoft to try to build new AI tools and not being at the head of the game on that. You can take Facebook or Meta. Again, Meta, trying to copy Twitter with threads. This lackluster amount of innovation is already one big problem. But outside of that as well, not only do we have a lackluster set of innovation in many of these companies, while I do respect the people who work for them and that many of them are running successful companies still, at the same time, we have them trading at incredibly high valuations and high concentrations of the market. Apple and Microsoft, this is a chart we shared in the Dash report here. Essentially speaking, we have been pointing out here that over the long term, these companies have swallowed a large portion of the entire equity markets. They together, between Facebook, Amazon, Apple, Netflix, Microsoft, and Google, they combined are worth $10 trillion. And that surmounts, when you're talking about the broader valuation of US equities, that total surmounts to around 22 to 23% of the entire valuation of all US stocks combined. All of this value concentrated in 7 companies. 6 companies. I bet on that. You can toss an NVIDIA in there too, and that figure goes up towards around $11 trillion. And even more percentage of the market, right? So we have this big concentration here. And again, everyone's piling into these companies, and they're hoping that, hey, every year I'm going to make, some people have really high estimates. Some people are thinking 30, 50, 100% each year. But even if you just talk about it from like a fundamentals perspective, you expect these stocks to double in the next 5 years. They've got to make around a 15% return every year, if you consider compounding interest, right? So essentially, these stocks have to keep delivering, and they've got to either do one of two things. They've got to either continue increasing their valuation multiples, the price people are willing to pay for those shares, which means there's got to be a pretty good excess amount of liquidity in the system. Well, we're getting contracting liquidity, so that's not really going to help us there. Or perhaps these companies fundamentally are just going to buck the trend that while other companies are going to crater and continue losing out, Amazon, Apple, Microsoft, all these big giants are just going to keep expanding somehow. So So that means we need strong consumers. We need strong, enterprise spending on a lot of these companies and their services, or more ad spend, right? Which, again, if we really go back to those fundamentals, guys, when you look around, do you feel that right now? Do you feel that this is the time where really over the next 3 or 5 years, we're going to be, just surmountably seeing 2 to 5 to 10 times more technology adoption in the economy? Or are we more realistically, while these companies are still very successful in many regards, that they're not going to grow so much and that we've kind of capped out on the last decade of growth of mobile phones, of social networks and ad revenue, and e-commerce during the pandemic? I mean, how much more can these companies grow? They certainly aren't exhibiting the kind of behaviors of growth in the way that they are innovating and investing into R&D, and along with that as well, and their focus on trying to excessively monetize their existing audience. That's not a sign where you want to take risk. That's a sign that a company is getting ready to pay you dividends and slowly wither off into oblivion. Don't believe me? Take a look at telecom stocks. Take a look at all the previous market leaders, Cisco Systems. Take a look at ExxonMobil. Take a look at General Electric. It is a repeated pattern where people continue to believe that certain companies are too big to fail and that they'll continue accelerating and growing, and they don't have the capacity to realize when the gig is up. While these companies may be great, that they've reached their maximum valuation potential, and while you may have a dividend that softens the blow, overall, on an annualized basis, you're either going to lose out to the market or you're going to lose money in the end. And that's not what we want here. I could tell you guys a different story, but that's the reality of it. Not to mention, here's an even bigger thing you need to consider. While we may have maybe too bearish of predictions here, perhaps we don't come down here into this support range on the S&P 500, which would mean a well over 50% correction from this point onward. I want you guys to just zoom out here again. Just the only thing I want you to take away from this is to consider rethinking our perspective here. Instead of DCA, consider here that we might have a lost decade like we did here in the 90s and to the early 2010s. We're only 13 years later, we finally broke to new all-time highs. That's what we need to consider here. And it's not just then. We zoom out, take a look at a period of time that's very similar to now, the 70s, where we had rampant inflation. We turn back through history. There are many periods of time like this where we may not get back to where we were. And I understand long term, as many of my good friends will always say, the number goes up and to the right. But it may be a while before that begins again. And you may have much lower valuations that you can get in on and a lot less emotions by being overexposed to the plays that did well over the last decade that may very well not be doing well in the next decade. I hope more than anything, guys, this proves valuable for you all. I hope it's food for thought. And the kind of stuff that you see here today can be very well found in our newsletter here on the channel, the Dash Report. Today, we're going to have our mid-month webinar. We're going to do some analysis just like this. We're going to dive into some deeper things that we don't cover here on the channel. I'm going to be answering questions from many of you out there. We've got dozens of people who join in on these webinars. They're always really fun, really insightful for me as well to just kind of hear what you guys are thinking about, some of the best members in our community. And on top of that, with the Dash Report, you get a 20-page monthly report covering crypto, Forex, commodities, and stocks. You guys will get access towards the trade alerts group. You'll get access to our blue-red momentum indicator on all time frames. And on top of that as well, you'll get access to the discussion group where you can chat with other dashboard members. There's so many things that we offer in the Dash Report, and we've tried to keep it at a really fair price for everyone here considering the offering. But I hope you guys will consider it. The link down below in the description. You can get 20% off on an annualized basis. And above all, it's a great way to get some extra content and support the channel and all the free stuff that we do here. But that's it for today's video, everyone. Thank you all so much for watching. I hope you guys have a fantastic day wherever you are and have a wonderful weekend. And if you can, share this video with a family member or friend if you found it helpful. Thanks so much for everyone for watching, and I'll see you all in the next video on Monday. Take care, everyone.